Chapters 5 and 6, Lecture Part 2. If you haven't seen Part 1, please review that first before viewing this video. Alright, this video is all about inventory. So, inventory is very important because it is one of the most valued assets, or it is the valued assets next to cash for a merchandiser. And because it is a valued asset, there needs to be an emphasis on inventory management. So the goals of inventory management, well, first you need to make sure that you have a sufficient quantity of it. You don't want to run out. You never want to be sold out of inventory, especially if your product is in high demand. Next, minimize cost to carry inventory. Storing inventory costs money. You as a merchandiser may be renting out or leasing a warehouse that you need to pay employees, pay the rent, pay the utilities for that warehouse. In respect to the minimizing the cost to carry inventory, it deals with production and, like I just said, storage. Another big one is obsolescence, where your product is not in demand anymore and is just taking up room in the warehouse and you can't get new product in. And finally, financing the inventory. If you are purchasing the inventory or making it, you need to finance it, and that costs a lot of money. Next, we'll go over total inventory cost. This is important because the inventory cost is recorded on the balance sheet. So on the balance sheet, you'll have a line, for example, that says, or an account that says merchandise inventory. There's a value for that, and that value is based off cost. So here I'm going to put recorded at cost. The cost for inventory, however, is not just what it costs you to purchase the inventory, but other things as well. So there's a formula. Here's a formula right here. So invoice, price, and then you're going to add any freight in. Freight in is if you're responsible for paying for the delivery charges for that inventory. You're also going to add any insurance, or I'm sorry, inspection. So inspection costs, insurance as well, if that is a part of it. Next, you want to add preparation costs. And then now you want to subtract a few things. So let's say, for example, you purchased a product and you returned it, or if there's an allowance on it, you want to subtract that. Next, you also want to subtract any purchase discounts, because it's the product that you bought may have been discounted, so you want to subtract that from the invoice price. And when you take all these things in consideration, you will get the total inventory cost. And that, again, as I stated earlier, is recorded on the balance sheet under current assets. Next, we're going to go over or talk about calculating cost of goods sold. Remember, cost of goods sold is what it costs you to purchase the product before you sell it to customers. It is on the income statement and it is considered an expense. This is important here because it's recorded on the income statement at cost, just like it was recorded on the balance sheet at cost. Let's go over the formula to calculate cost of goods sold. In reality, it's a formula to calculate ending inventory, but cost of goods sold is part of this formula, and you could do a little bit of algebra and find the missing amount if any problems give you the other amounts. So the formula begins with beginning inventory. So that's what you already have. Then you're going to add purchases if you purchase some more. When you add that, you will get goods available for sale. Then you're going to subtract cost of goods sold. So you had things available for sale, and then you sold some goods, and there's some costs associated with that. And so that's why you subtract minus cost of goods sold, or you could think of it as inventory leaving, cost of goods sold. You will get ending inventory. So again, beginning inventory plus purchases equals goods available for sale. Then you subtract what left, which is cost of goods sold. and then you get what's remaining, which is ending inventory. Again, in problems, they'll give you certain amounts. You just have to find the missing amount or value. Next, we're going to talk about perpetual inventory system and periodic inventory system. I talked a little bit about this in the first video, but we have to review it because we're going to assume that all our examples are using a perpetual inventory system. So let's review. Remember that a perpetual inventory system is where inventory is updated continuously. So at all times, a merchandiser will know what they have on hand in respect to inventory. In comparison, periodic inventory system, the inventory is updated only once a month. So this is good for places where they don't have a lot of inventory, or they can keep track of their product by site or by count. In respect to perpetual inventory system, very expensive, very costly. You need things like scanners, computer programs, and tracking devices to be able to know where your product is. If you go into a store and they let you know how many of a product they have, or what location or what other store location they have it at, well, you know that they're using a perpetual inventory system if they can tell you how many they have, what quantity, and where, because they're using their scanners and the computer programs are keeping track of where things are. I'm going to stress, under a perpetual inventory system, purchases and sales are recorded periodically at all times. It may not be instantaneously, but it will be updated very, very fast compared to a periodic inventory system where the sales are only recorded once a month. So let's go back to inventory costing methods. Why are we talking about costing methods? Because when we record inventory or merchandise inventory on the balance sheet, it's recorded at cost. It's the same thing with the income statement. When we record it down on the income statement, it's recorded at cost. And because inventory is recorded at cost on two financial statements, we have to figure out a way to record, or how to record, the cost of that inventory when it's purchased and when it's sold. All right, so normally, or usually, there are four methods to track cost and to determine cost of goods sold. The first one is called first in, first out. Abbreviated, it's called FIFO. So first in, first out is where you sell the older inventory first. The second method is called last in, first out, or LIFO. This method, you sell, or it assumes that you sell the most recent inventory first, so the newer stuff first. And when I talk about inventory, we assume that it's all the same type of product. The third one is average cost, where you're taking an average of the cost. And the fourth one is called special or specific. I put special there, but it should say specific identification. In this chapter, we're going to go over first in, first out, and last in, first out, and a little bit of average cost, but I am emphasizing first in, first out, and last in, first out for our examples on our videos and most of the homework problems. But we have to also make one assumption here. It's a cost flow assumption, so these problems we can understand a little bit better as we go through them. You're always going to assume that the prices are increasing. Meaning, when you go buy inventory, the vendor or supplier is always increasing the price of that inventory when you go purchase it. I made a little diagram here. The first column is FIFO. If you notice, there's the recent inventory on top and the older inventory on the bottom. And like I said, first in, first out, the older inventory, which was purchased cheaper, leaves first when you sell it. Okay? Second column is called LIFO. Again, the recent's on top, the older inventory is at the bottom. We're assuming that it's a little bit more expensive, your more recent inventory, but that's what you sell first when you sell it to a customer. The third one is average cost, and that's where you take an average of the costs and you consider that when you record cost of goods sold. Now we're going to go over some examples. All right, our first example is first in, first out. I got examples here. Here are the transactions. And for each transaction, we're going to record the journal entries. So the first transaction is you purchase 4 shirts for $1 each. You purchase it from a supplier or vendor. So here we go, 4 shirts for $1 each. And that's what you have in your inventory. So when you record that down, let's assume it's on account. So we're going to debit merchandise inventory. And remember, we're recording it on the balance sheet at cost, okay? So that's 4 shirts for $1 each. So we're going to record the inventory at $4. As I said, let's assume these transactions are on account. So you're going to credit accounts payable because now we owe someone in the future $4. That someone being a supplier or vendor. Next, we're going to purchase some more. So we called up the supplier. We need more shirts for our inventory. This time we ordered 6 shirts. And remember the cost flow assumption where the supplier or vendor is consistently raising the price. This time around, they sold the shirts for $2 instead of 1. 2, 4, 6, 8, 10, 12. So we're going to record it at cost on the balance sheet. So merchandise inventory on the balance sheet is $12. Accounts payable, let's assume it's on account, is also $12. I mean, if you asked what was on the balance sheet right now, it'd be merchandise inventory at $16. The third transaction, we purchased more shirts for our inventory, 4 shirts, and this time again they raised the prices to $3. So we're going to debit merchandise inventory for $12. So 3 times 4 shirts is $12. Let's again assume it's on account, so we're going to credit accounts payable. And accounts payable will be also for $12. So we accumulated all this inventory, and every time we ordered more shirts, the vendor or supplier kept raising the prices. And now we finally sell 6 shirts to a customer. When we sell these shirts, remember this is first in, first out. You sell the older inventory first, and you do not sell the recent inventory until last. So the older inventory is made up of the $1 shirts and the $2 shirts. So we need 6 shirts. So I'm going to take 6 shirts from here, 1, 2, 3, 4. So we'll take it from the shirts that cost us $1. We need 2 more. I'm going to get those 2 more shirts from the $2. Again, because this is older inventory compared to the $3 shirts. And there it is. So when you record a sale, you always need to consider 4 accounts. And again, let's assume when we sold these shirts, it's going to be on account, where the customer owes us, or we expect to receive money in the future from the customer because they didn't pay cash right away and they'll pay in the future. So we have to debit accounts receivables for, well, it's 6 shirts, right? So 6 shirts, and we sold the shirts for $100 each. So the accounts receivable amount should be for $600. So 6 times 100 is $600. We also have to record the sale, so that's a credit to sales for the same amount, $600. Now we're going to record the expense related to that sale. The expense in this scenario is considered cost of goods sold. And the cost of goods sold, I'm going to keep repeating this, is recorded at cost. And in my diagram or picture here, the cost of the shirts is the 4 ones and the 2 twos. So that will give us $8. So cost of goods sold is $8. It's a perpetual inventory system, so we got to credit merchandise inventory to make sure it updates our record that it's going down, also for $8. The cost of goods sold will always be less than the sale because, ideally you're selling it for more than what you got it for. Here we're going to record the balance sheet. After this transaction, what was left over on the balance sheet on the merchandise inventory? Well, it's $20. The sales on the income statement is $600. It's that 6 shirts times $100. And then your cost of goods sold is what left. You could look at the shirts up above where it says sale, or look at the journal entry We only had one sale, and that is for $8. Next, we're going to go over a last in, first out example, or LIFO. Last in, first out. We're going to do the exact same example just to show you the difference in respect to FIFO and LIFO. All right, so we purchased 4 shirts for $1 each. Again, we're going to assume it's a perpetual inventory system. So you want to debit merchandise inventory to increase that account for $4 because it's recorded at cost. We're going to assume it's on account, so it's going to be a credit to accounts payable for $4. Next, we purchased 6 more shirts for $2 each. Remember, we're assuming that the supplier or vendor keeps increasing their prices. Here they increased their prices for the exact same product. It was $1. Now it costs us $2 to get some more. We're going to increase the merchandise inventory by $12. We're going to assume it's on account, so credit accounts payable for $12. We again purchased some more shirts, and when we did, the supplier increased our prices to $3. It's the exact same shirts, I got to stress that. It's a perpetual inventory system, so we'll increase merchandise inventory to update our inventory records. This time it's for $12, and it was on account, so let's credit accounts payable for also $12. Finally, a customer bought some shirts from us. They bought 6 shirts. We sold each shirt for $100. Now, this is where FIFO and LIFO matter. Because in LIFO, you want to sell the most recent inventory first. And in this case, the most recent inventory is the shirts at $3 and the shirts at $2. The older inventory is the shirts at $1. Again, this is LIFO. So now, when we sell these 6 shirts, we're going to take from the most recent, which is 4 shirts at $3, and 2 shirts at $2. When we do that, let's assume it's on account for the customer. Now we expect to receive money in the future. That's an asset, so you're going to debit accounts receivable for what we charge the customer, which in this case is 6 shirts for $100 each. That's going to be $600. Then you want to record your sales for the same amount, which is $600. Now we're going to record the expense related to the sale, which is called cost of goods sold. And this amount is based on costs and based on what was sold to the customer. In this case, it's the 3 at 4 and 2 at 2. So that will give us $16. You want to credit merchandise inventory to decrease that account, so it's constantly updated, and that will be for $16 as well. Next, we'll go over the balance sheet. The balance sheet, it will show what inventory we still have left over after all your sales. We only had one sale in this example. So here we're just going to add up all the costs of the shirts that are still there. The cost is $12. On the income statement, we have to record sales. The sales is what you charge the customer, and what you sold, that is $600. And the cost of goods sold is the cost of the shirts, what it cost you to get before selling them, and what left your door when you sold them, and that is at $16. Let's make a quick comparison between LIFO and FIFO. If you look at here's a merchandise inventory. It's $12 for LIFO and $20 for FIFO. So there is a difference. The sales, it actually doesn't change because you, in each scenario, you're charging the same amount, $100 for each shirt. So 600, 600. And then finally, your cost of goods sold, yes, there's a difference. It's $16 for LIFO and $8 for FIFO. All right, we'll go to another example because we can't be dragging shirts and drawing shirts, and we can't be doing that. So in the textbook, and what it really looks like is this. So here's a FIFO example. You purchased some goods, you sold some goods, you purchased some goods, you sold some goods, you purchased and then sold. That's what real life kind of looks like, where you purchase inventory and then you turn around and sell it. And there's multiple transactions, just not one sale like we did in the previous example. So I do 4 columns. I like to set it up with 4 columns to keep track. I have a date column, a purchases column, a cost of goods sold column, and a current inventory column. On November 1st, we got 600 units at $80 each. And then I'm going to update that last column, $600 at $80 each. always update the last column, okay? On November 4th, we had a sale of 200 units. I mean, if it's 200 units and we have 600 units of our goods at $80, we're going to pull from there, okay? All right, so we're going to subtract. We're going to update our inventory. Brackets means subtraction. So right now, after that sale, we have 400 units and it cost us $80 each. All right, on November 11th, we purchased more inventory. And unlike an earlier purchase, the supplier/vendor raised their prices from $80 to $82. So we got 350 more units of inventory, same inventory at $82. I want to update our inventory on the last column, so 350 at $82. So right now, units wise, we have 750 units, but they're valued at different costs. The top is older, the 400, and the newer stuff is the 350 units. This becomes very important, the older and the newer inventory, because this is where FIFO matters. So on the 12th, we sold 275 units. I'm going to stop right here. Here, you have to ask yourself, where am I going to get those 275 units? Am I going to pull it from the 400 at 80 or 350 at 82? Well, it's FIFO, so you want to sell the older inventory first. The older inventory is the 400 units at $80. So I'm going to pull my 275 that I sold from the 400 at $80. So here I'm just going to note it that these 275 units are valued at $80. I'm going to update my inventory, the very last column. So 275 at $80. I'm going to put brackets around it because I'm subtracting it from inventory. That leaves us with 125 units at $80. So 125 units at $80. Remember, that's the older inventory remaining. And we still have that 350 units at $82. So I'm going to still put that down because that didn't leave the warehouse. So $350 or 350 units at $82. Next, on November 22nd, we purchased some more. And guess what? The supplier raised their prices to $84. Okay, so sorry about that. So we're going to go here. Again, it's November 22nd. We purchased 175 units at $84. So I'm going to put that on the purchases column. And remember, always update the last column because you're updating your inventory. So I'm just going to add the 175 units at $84. And those are all our units thus far. They're all valued at 3 different costs, but that's how you got to keep track. Our last transaction took place on the 23rd, and it was a sale to a customer of 155 units. So remember, this is first in, first out. You have to sell the older inventory first, not the recent one. So the older inventory. So I'm going to pull from the 125 units at $80. I'm going to do a breakdown under the 155. So 125 at 80, and we need more because 125 is not enough for the 155 units that were sold. So I'm going to pull the rest from the 350 units at $82. So if you're doing your math, it's 155 minus 25, and you need 30 more units. And that 30 units is a cost of, or each costing $82. So let's update our inventory. I'm going to subtract 125 units at $80 and 30 units at $82. The 125 is all gone. And 350 units at 82 were partially sold. So you got to update that to 320 units at $82. And we still have the most recent inventory still there. It wasn't touched. So 175 units at $84. And there you have it. A perpetual inventory system. I know I didn't do the journal entries. That would have taken forever, but if you need reference to the journal entries, go to the previous slides. Let's talk about the balance sheet. What is the merchandise inventory? Well, that's the remaining inventory, what's still there after all the purchases and sales have taken place. It's really, that's why the last column is important to do, because it's an updated inventory value of what's still there. Right now, it's the 320 units at $82 and the 175 units at $84. I got to emphasize that this inventory has not been sold and is still there, and that's what belongs to the merchandise inventory on the balance sheet. We're going to get $26,240 for our first calculation and $14,700 for our second calculation. You want to add those two things up, and that will be the value of your merchandise inventory on your balance sheet. So $40,940. $40,940. Next, what's our sales? We can't really answer the sales because in this example, I didn't give a sale price. But if you had a sale price, you just take the sale price and multiply by the total units you sold, and you'll get your sales. Your cost of goods sold, if you set up this chart correctly, are all the things that are in brackets, because those units left, meaning they were sold and they were valued at a certain cost. And if you've been doing it right or been recording it correctly, we've been recording the cost. So the first one is $200 at $80. Next one is $275 at $80. I'm sorry, 275 units at $80. Next one is 125 units at $80. And lastly, we have 30 units at $82. We're going to do some calculations right now. So 200 times $80 is $16,000. 275 units at $80 is $22,000. 125 units at $80 is $2,000. And 30 units at $82 is $2,460. You're going to add all those up. That will give you $42,460. And that is your cost of goods sold for $42,460. Actually, I realized I made a calculation error. The 125 units times 80 should be $10,000. So I'm $8,000 short. So the cost of goods sold should be $50,460. I'll correct that on the PDF. All right, next we're going to go over a LIFO example. So last in, first out. What's important about this? You're going to sell the most recent inventory first, okay? This example takes place in April. We have beginning inventory, a purchase, a sale, a purchase, and finally a sale. Just like the last example, I like to set up these calculations with 4 different columns: a date column, a purchase column, a cost of goods sold column, and a current inventory column, which you will constantly update after each transaction. All right, let's start with April 3rd. In April 3rd, we didn't have a purchase or we didn't have a sale, but we did have existing inventory. And that existing inventory was 12 units at $45 each. On April 11th, we had a purchase. So we purchased more inventory from our supplier. This time we purchased 13 units at $47. They increased their prices. So currently our inventory is made up of 12 at $45. That's the older stuff. And 13 at $47, and that's the more recent stuff. This matters because when you sell your product, which in this case happened on April 14th, so you had a sale of 18 units. Here you have to ask yourself, do I pull from the older or from the newer stuff? Well, because it's last in, first out, you have to take it from the more recent inventory. And in this example, it's the inventory valued at 13 at $47. So I'm going to take all of the 13 at $47. We don't have enough. We need 5 more units, and I'm going to pull from the older inventory. because the 13 at 47's all gone. So 5 at $45. As I said, and we did in the last example, update your inventory column so we keep track of the current inventory. So 13 at $47, put that in brackets, and 5 at $45. So the 13 at 47, that's all gone. We used all that up. We sold all that. And then we took 5 from the 12 at 45. So that gives us a remaining inventory after the sale of 7 units at $45. So that's the current inventory, 7 units at $45. Next, we purchased more inventory. That took place on the 21st. We purchased 9 units, and the prices went crazy because this time, for whatever reason, we purchased it at $60, which is terrible because originally we got our inventory for $45 and $47. But for whatever reason, the prices went really high, and this time it's 9 at $60. So our current inventory is 7 at 45 and 9 at 60. Our last transaction took place on the 25th. It was a sale for 10 units. So here's the 25th, and we sold 10 units. This is where FIFO and LIFO matter. This is last in, first out. And if it's last in, first out, you're going to pull from the newer inventory first, or you sell the most recent inventory first. In this case, it's 9 at $60. So we're going to take all of the 9 units at $60. And because we sold 10 units, we need to get one more unit. And we're going to pull that one unit from the 7 at $45. So here, 1 at $45. Next, we want to update our inventory. So let's update our inventory here. The 9 at 60. We're going to take that out because we sold it to customers. And 1 at 45. When we update our inventory, all of the 9 at 60s are gone. And what's remaining from the 7 at 45 is 6 units at $45. That represents the inventory that is still there. So 6 at 45 is the current inventory. So if a question asked, what is the current inventory? Well, what that's asking, what is the merchandise inventory on the balance sheet? Well, it's the inventory that's still remaining, and that's why that column is very important to keep track of. So your merchandise inventory right now is made up of the 6 units at $45. That will give us $270. So we're going to put $270 on the balance sheet. Next, we go to the income statement. We can't calculate the sales because I didn't give you enough information for what the company sold each unit for, or a selling price. Next, we're going to calculate cost of goods sold. The cost of goods sold is what is really the cost of all the products that we sold that left. So here's our cost of goods sold. And if you look at that last column, it's anything in brackets. Because remember, we put brackets around those values because we sold those units. So it's 13 at 47, 5 at $45, 9 units at $60, and 1 unit at $45. We're just going to calculate this. And once you calculate each one, the first one's $611. Once you calculate each one, you want to add them all up, and it will give you a cost of goods sold. 5 times 45 is $225. 9 times 60 is $540. 1 times 45 is $45. So let's combine that, and we will get $1,421, and that is the cost or the value of your cost of goods sold, $1,421.